Hi, my name is Lars Fontin and I'm from the Foundation for the Study of Cycles, and together with my colleague Andy, today we want to give you some basic insights on very important current active dominant cycles within the market. So Andy will start with a larger picture and some broader cycles, and then afterwards we will dig more closely into daily cycles to give you a short idea on how cycle research and cycle analysis can guide you and help us providing a window into the future. So Andy, please make us comfortable with the longer term cycles first.
Hello, my name's Andrew Pancioli. What we do is we look at how events occur and recur. And whilst we primarily focus on the markets and geopolitics, I've done this video because I appreciate that we're in a time of crisis. And I want to give you some background information so that you understand what's going on and you can see the things that we see. So let's take a look at some of the factors that are coming in and the mathematical patterns that recur in human behavior and nature. And that's what's coming together right now. So we're in a crisis here. It's 2020. And what I'm going to take you through is some patterns to help you understand why we're here, and also to give you some hope and some shine a light on the fact that we will come out of this. So what we look at, and we've looked at time and time again, and we continue to do so, is that human behavior moves in cycles, in mathematical patterns, and events recur in patterns as well. They follow time cycles, as you're about to see. And when these cycles come together, bigger events occur, and that's exactly what's been happening. And this can be forecast, and in fact, that is our core business. We have been warning people about this over the last several years. But it doesn't matter about that. I want you to look at this. This is here to show you why everything's come together, or how everything's come together. I'm going to start off with virus cycles, and what we see here is that we're here we're actually in March 2020 now, and the first reports of this COVID-19 coronavirus came from China at the very end of December. So it's obviously been proliferating in China back in December 2019, probably slightly before that. Now, if we go back and we look at a particular cycle, it's around about 18 years. It can be plus or minus, and cycles in human events are slightly fuzzy, where they're more precise in commodity markets and other things. But this is the same sort of principle. If we go back 18 years, it's roughly 18.6 years. It takes us back to November 2002. 18 years, and we had SARS break out in the Far East in Singapore, and that was again very, very big at the time, although we far exceeded the number of deaths with COVID-19. And go back again the same time cycle, and around about this sort of 18 to 18.6 year cycle, AIDS and HIV was proliferating. So we've got these double cycles coming together, and two of those together make a 36 year cycle, which is why this is a little bit more potent. And then you can go back another cycle of around about 18 years. It's actually slightly fuzzy here, and that takes us back to Asian flu. So this is why we've got the virus cycles coming together, and predictively, obviously, you would look ahead another 18 years, but that's not the purpose of this video. So that's the first point, is the virus cycles have come together. Now, this has impacted the world. The COVID-19 coronavirus has impacted the world, and it's taken its toll on the stock market. That's common knowledge now. We've got a big crash that's going in. Obviously, we're going to get a bit of a pullback at the moment at the time of filming, but we are really peaking out here in the stock market. We have peaked out this last 2 to 3 weeks, and the reason is we're in a 90-year cycle from the 1929 crash. And then you can go back another 90 years to 1839, and there was a massive crash between 1837 and 42. These are significant economic cycles, and they do occur in these patterns. So the 90-year cycle is very important in human behavior. You'll see it across a lot of historic events repeating at 90-year intervals. Again, outside the remit of this video, but I just want to show you that this is what's been coming in. We have been forewarning people about this for the last 5 years, and we also wrote a book called 0 Hour about this. So that's a cycle crash that's in. Let's just think about this. 1929, the crash came in September. 3rd of September was the high, and the crash followed in October. So when you look at a 90-year cycle, we're only 2 or 3 months. We're not even that really out of tolerance. And that went on to have an economic slowdown that lasted into July 1932. So we are in a situation where there is going to be a bit of an economic slowdown. I don't think it's going to be fixed overnight. It might take a year or so, or maybe a couple of years, but it is a big cycle. And then, if you look back, there was a similar thing. 1929 was a 90-year cycle on from 1837, which saw a big crash. And this was due to overexpansion in the canal building industry around the Great Lakes and land boom and so on in America, and similar things were happening in Britain as well. So these cycles sort of repeat like this, and it is this long-range view that gives us the ability to see these things, and we are here now. So these are the factors that are coming together.
Thanks, Andy. As we've now seen how the larger pictures of cycles looks like, let's now dig into more the cycles within cycles approach, because now we have the broader picture and we've seen that even larger cycles are now coming in sync. So now let's move one level more down on daily cycles and see if we also get a clue from daily cycles. To inform you upfront, the following charts I will share with you have been published in the first half of February. So it's important to keep in mind, if I show you now the next slides, that all analysis which I will share with you has been done in the first half of February. And it's important to notice that even by today we have these corona crisis, but at the point I will share you now the analysis, it has all been done in the first half of February. We are just looking at Italy. We just had the first 1 to 3 cases, so we have not been aware of what will happen just in the second half of February where we are now. So therefore it's really important what cycles can guide us through. So let's start with a kind of daily analysis here now. At the beginning of February, this is the S&P 500 stock market index on a daily scale. Andy started with a larger picture of very long cycles, so 90 year cycle, and has shown that we've seen the alignment. Now, when you do cycles within cycles analysis, it's now important to drill down your time frame to get even more clues on a more shorter time frame. What you see here down below is a daily cycle which has been detected within the Foundation Cycles Analyzer, and it's just plotted on the chart. And the interesting point here, it's quite obvious to see, is that at the beginning of February, the cycle has rolled out over, and even from a daily point of view, it's now showing that we are in a downward move on the major dominant cycle with a length of 173 bars. And please keep in mind the lengths now, because this will be important if we browse through the other charts. But it's always not enough to look at just one cycle. This is another important cycle, and as Andy mentioned also before, we are talking about fear in the market. And this is an interesting chart because it shows the VIX index, so the volatility index, and this is also called kind of fear cycle on the daily scale. So the blue line here is the VIX data set. And you see here at the beginning of February, where this analysis was also done, we have a very low reading in the VIX cycle. And the cycle here, which is an overlay on this cycle, this is the automatic detected dominant cycle by the Foundation Cycle Analysis toolset. And this showed you a major fear low at the end of last year, beginning this year. So in regards to the length, now we have 180 bars detected from a length cycle. You see it's very similar to a stock market cycle of 173 bars. It's not about 1 or 2 bars plus minus. So the sentiment cycle is in the same length and the same phase here as a stock market cycle. And it's important now that lows within the fear correspond to stock market highs and vice versa. So the reading of fear cycles is exactly the opposite as if you look at kind of market cycles. So, and it indicates here that also the fear cycle has now rolled over at the beginning of 2020, and we would expect a major increase in the fear in the markets, which was then similar reading to the stock market cycle that we would expect the markets to turn down. And it was the same date, it was here the first half of February. So even this larger cycle would have indicated us to expect a downturn. If you go through the data, you see that it's quite good aligned to how the raw VIX index behaved. However, it's not accurate based on a day-to-day basis. But the reading is, if you come from the 19-year cycle now to the daily cycle, you would be on high alert that the high in the stock markets, it's looking that's turning over at the beginning of February. So in the third cycle we could look about, and this is then dealing with kind of composite cycle forecast where you choose the most important cycles which are active in the market. So here based just on an Amazon stock market data chart, again done in the beginning of February. On the right hand side you see which cycles have been detected, again fully automatically by our Foundation Cycle Analyzer. And you see that 2 cycles have been selected at this point in time here. And the reason why is quite simple. You see that the strength of these 2 cycles is the highest compared to the other cycles listed here. And the Bartels score, which gives you a kind of confirmation that there's a real cycle in it, is also the highest reading here. So based on these strengths and Bartels filtering, it makes sense just to pick these 2 cycles here. And these 2 cycles have then be plotted as an overlay cycle here then on the chart again. So you see the blue data is the raw stock market data of Amazon. And the overlay cycle here is just based on these 2 cycles here with their respective phase. And you see already from the chart and the reading how good the cycle just based on 2 cycles fits to the market behavior here of Amazon. And here again, the interesting takeaway was at the beginning of February that if you see the last 1.5 years of the Amazon stock market cycle, that based on the beginning of February, the stock market should have reached a high. And the cycle, the composite cycle now turned down for the technology stack and for Amazon. So this again was beginning of February, pointing down now into the end of March period here. So even expecting from Amazon the same forecast here. What's interesting is here in this picture, not only looking on one cycle, as I shared with you, I shared with you the daily S&P cycle, the fear cycle, and the technology Amazon cycle as a composite cycle forecast. And all 3 cycles, even different data sets, tell the same story. So, and then if you put this into the scene, which Andy told us just before from these yearly cycles, this is what cycle analysis can show you. It gives you kind of window into the future. And the more and more cycles are in alignment, then the more and more valid such kind of window and cycle analysis will be. What we share here with the Foundation for the Study of Cycles is just the knowledge so that you can do similar analysis on your own. And all the charts we share here, and these charts are out there for years already, and being on alert for the longer term cycles. And what I shared here with you, these cycle analysis has been put into public articles which have been published at the 15th of February. So right before markets turned down. So we can prove here that this has nothing to do with after the fact. So please browse our Foundation library and make yourself comfortable with cycle analysis, because it's not only a window on the future. Right during these times, it's quite an important knowledge, even to see when the cycles will turn up again and we get into the positive spin then afterwards.
So that's the purpose of using cycles. You know, we are not in a good place right now, but it will get better and we will recover. We talked about seasons just now, how we're basically the first 3 months is spring. And so with regards to the COVID-19, basically spring cycle season really started from late December and we're coming to the end of spring now into summer. Well, the bad news with summer is things tend to grow quite quickly and sort of proliferate. So that's why the next 3 months are going to be critical. And then after that, we will look at basically leaving summer into autumn, and that's likely to be a peak. So that's why we talk about seasons. And then after that point, winter follows, and that's when things will clear up. And of course, then all of us will work together and look forward to the next spring when things definitely will get better.